Investing in the stock market can be one of the smartest decisions for building long-term wealth. However, diving in without preparation is a mistake that many beginners make, often leading to poor decisions, emotional investing, and financial loss. To invest wisely, you need more than just a brokerage account. You need clarity, purpose, and a strategy aligned with your goals. Asking the right questions before you invest ensures that you're not just reacting to hype, fear, or peer pressure. In this video, we break down the 10 most important questions you should ask before putting any money into the stock market. Whether you're a first-time investor or someone revisiting your portfolio, these questions will help you make informed, confident decisions. 1. What are my investment goals? Before you put a single dollar into stocks, ask yourself, why are you investing? Are you saving for retirement, a down payment, your child's education, or financial independence? Your investment goals determine your timeline, risk tolerance, and asset allocation. For instance, a long-term retirement goal might support a stock-heavy portfolio, while short-term goals may require a more conservative approach. Without clearly defined goals, it's easy to invest randomly and lose sight of your financial direction. 2. What is my risk tolerance? Risk tolerance is your ability and emotional capacity to handle market volatility. Some people can stomach wild market swings, while others panic during the slightest dip. Ask yourself how you'd feel if your investment dropped 20% in value overnight. Your answer helps you determine what kind of stocks or funds to invest in. Risk tolerance varies by age, income, experience, and personal mindset. Ignoring it can lead to panic selling or missed opportunities. 3. Can I afford to lose this money? The stock market involves risk. Before investing, ensure that the money you're putting in isn't needed for essential expenses or emergencies. You should have an emergency fund, typically 3 to 6 months of living expenses, fully funded before investing. Ask yourself, would losing this money derail your life? If the answer is yes, you're probably not ready to invest that amount yet. 4. Do I understand what I'm investing in? A common mistake new investors make is buying stocks they don't understand, often because of social media tips or trending news. Always ask, do I know what this company does? What are its core products, its business model, and how does it make money? If you're investing in mutual funds or ETFs, understand the sectors and strategies involved. Legendary investor Peter Lynch advised to invest in what you know. Ignorance is expensive in the market. 5. Am I diversified enough? Diversification is your main defense against risk. It means not putting all your eggs in one basket. Are you spreading your investments across industries, companies, and asset classes? If you're heavily invested in a single stock or sector, your portfolio is vulnerable to market shocks. Ask yourself, if one investment fails, how much of my wealth will be affected? A diversified portfolio can absorb losses better and position you for long-term stability. 6. What is my time horizon? How long do you plan to keep this money invested? Your time horizon affects your risk level and investment choices. A 30-year-old investing for retirement can ride out bear markets, while a 60-year-old nearing retirement may need a more conservative approach. Short-term money, needed in 1 to 3 years, shouldn't be in stocks at all. Matching your investments to your timeline reduces the chance of needing to withdraw during a market downturn. 7. What are the costs and fees involved? Every investment has a cost: brokerage fees, fund expense ratios, taxes, or trading commissions. Over time, these can eat into your returns. Ask, how much am I paying, and is it worth it? Index funds typically have lower fees than actively managed funds. If you're using a financial advisor, make sure you understand how they're compensated. Lower costs don't guarantee better returns, but high fees definitely reduce your profit. 8. What happens if the market crashes tomorrow? This is a hypothetical but critical question. Are you emotionally and financially prepared to handle a sudden 20 to 30% market drop? If the thought makes you anxious, you might need a safer investment mix. The stock market has cycles, booms and busts are part of the journey. Having a plan and emotional discipline during downturns is vital. Ask, would I sell out of fear, or stay the course knowing that recovery is likely? 9. Do I have a long-term strategy, or am I just chasing trends? Many people buy stocks based on trends, hype, or FOMO, fear of missing out, rather than strategy. Ask yourself if your investment is part of a larger financial plan, or just a reaction to market buzz. Trend chasing often results in buying high and selling low, the opposite of what successful investors do. A sound investment strategy is goal-driven, data-informed, and boring in the best way. Discipline beats speculation every time. 10. Am I emotionally ready to handle market ups and downs? Headline: Investing isn't just financial, it's emotional. Can you handle the highs and lows without making impulsive decisions? Emotional investors often buy at peaks and sell during crashes. Knowing your psychology is key. Are you patient, calm, and willing to stick to your plan through volatility? If not, consider automating your investments and minimizing how often you check your portfolio. Emotional resilience is one of the strongest traits of successful investors. Investing in the stock market can be a rewarding journey, but it starts with self-awareness and preparation. Asking these 10 critical questions can help you avoid costly mistakes, clarify your strategy, and build long-term wealth with confidence. Remember, successful investing isn't about predicting the next big thing. It's about having a plan, understanding your goals, and staying consistent over time. Before you click buy on your next stock or fund, take a step back and reflect on your answers to these questions. Smart decisions now can lead to financial freedom in the future.